Today we're going to talk about synthetic risk transfer transactions, or SRT as they're commonly referred to. SRT involves the purchase of credit protection on a portfolio rather than on a single asset, and can be a useful tool for banks seeking to manage their overall credit exposure and the use of capital supporting the balance sheet. Today you see a wide range of underlying asset types, from consumer-related risk, such as auto loans and student loans, to corporate-related exposures. Banks are able to free up capital by selling into the private credit markets the first loss tranche. This can be the 0 to 10% part of a capital structure, for example, and for that, the investor will be paid a yield for the risk that they are taking. The bank does continue to retain exposure to the portfolio and will bear losses which exceed the protection provided by the investor's SRT purchase. We have seen banks in Europe use SRT for many years as an effective tool for managing capital in the early days of the Basel Rule rollout and subsequent versions of that. It has been adopted more recently by U.S. banks following the approval of the Federal Reserve in September 2023. Our view is SRT issuance in the United States will match the level of issuance we've seen in Europe and will have done so in less than a 2-year period of time from its rollout into the market.
From a bank perspective, the key benefits of SRT include balance sheet management, giving banks a tool to be able to dynamically manage their capital requirements, concentration risk, and credit risk. From an investor standpoint, SRT actually gives us access to bank-originated assets in a way we might not be able to replicate in other forums. So let's talk about a hypothetical example of a bank contemplating raising capital and looking at their various alternatives. A bank might consider raising capital to either buffer their own capital ratios, fund organic growth, or even something as strategic as contemplating M&A. There's generally 3 different alternatives that a bank could have to raise capital. Number 1 is going to the equity markets directly. In today's market conditions, that could be very expensive, but it is open selectively. Number 2 is they could contemplate selling loans, but given today's interest rate environment, that's generally quite difficult because there's a lot of embedded mark-to-market losses just given how high interest rates are today. Or they can contemplate an SRT, whereby they will sell the equity risk, the credit risk of a certain portfolio, relieve the capital requirements of that book, and keep the assets on their balance sheets without actually transferring them into a structure or incurring any mark-to-market loss there. The bank will generally drive the conversation of what assets to put into an SRT. Let's say the bank considers to move forward on a mortgage SRT. They will put forward a portfolio, a suggestion of where the starting point for that kind of transaction would be. We would take a look at the underlying portfolio, suggest tweaks around the edges based on our own preferences for asset selection, and also engage in a conversation with them on how much protection we want to provide them under the SRT structure. There's a regulatory minimum of the amount of protection the bank is going to need, but there's also a fair degree of flexibility to be able to say, maybe we want to offer a less levered or wider tranche to the bank, which gives us a slightly different risk proposition as opposed to a more highly levered structure, but also gives the bank themselves a little bit more flexibility in a downside scenario. Our advantage in these conversations is generally our ability to operate across multiple asset classes. We're one of the few entities in the market that is truly flexible across so many different asset classes there, and it's because we have the ability to tap all of the resources that are PIMCO and all of our asset expertise across all of the different verticals that we touch as an asset manager.